Here is the uncomfortable truth that most crypto content will never say directly to your face. The market is not what is making you poor. Your habits are. And the reason this is so hard to hear is that these habits feel completely normal. They feel like responsible behavior. They feel like staying informed, being active, managing risk. But underneath the surface, quietly, persistently, every single week, they are bleeding your portfolio in ways you are not even tracking. A survey of over 1,200 crypto traders published in August 2025 found that 84% lose money in their first year, 58% lose almost everything. And the two most common reasons? Poor research and FOMO. Not bad luck, not a rigged market, habits. So let's go through the 6 that are most likely costing you right now. And let's do it like two people having an honest conversation, because that is the only version of this that is actually useful. Habit 1. Overtrading. Paying fees and taxes on every single move without realizing how fast it compounds. This one is sneaky because it does not feel like losing money. It feels like being active. It feels like doing something. You see a coin that looks like it is about to move. You swap out of your current position to catch the run. You make a small gain. You feel good. And somewhere in the background, completely invisible to you in the moment, a percentage of every single one of those transactions is disappearing. Exchange fees, gas fees, spread costs. And if you are in the United States, every single swap, every single trade, every single conversion between coins is a taxable event, not just when you cash out to dollars, every trade. The IRS classifies cryptocurrency as property, which means swapping Bitcoin for Ethereum is the same as selling a stock. If you held that position for less than 12 months, which most active traders do, you are paying short-term capital gains tax at your ordinary income rate. That could be anywhere from 22% to 37% depending on your bracket. Compare that to holding for over a year and paying the long-term rate of 15% for most people. A $100,000 gain taxed short-term at 37% costs you $37,000 in tax alone. The same gain held for 12 months and taxed long-term at 15% costs $15,000. That is a $22,000 difference from one decision, to hold instead of trade. Multiply that across a year of active trading, add the fees, add the spreads, and the people who feel the busiest in this market are often the ones walking away with the least. The simple, unsexy truth is that in crypto, as in most markets, activity is not the same as profit. For most retail investors, doing less generates better after-tax, after-fee returns than doing more. That is not a theory, that is arithmetic. Habit 2. Checking the price too often and making emotional decisions disguised as staying informed. Be honest with yourself on this one. How many times a day do you open your exchange app or CoinGecko and check your portfolio value? 5 times? 10? Every hour? And what happens when you see it down 3%? Something shifts, not rationally, emotionally. You start reading articles to justify what you are feeling. You look for reasons the drop is permanent. You find someone on X saying the coin is dead, and before you know it, you are making a sell decision that has nothing to do with the fundamentals of the asset and everything to do with the fact that a number on a screen is smaller than it was this morning. Research into cryptocurrency investor behavior is unambiguous on this. Emotional decision-making driven by short-term price observation is one of the primary drivers of the retail loss pattern. 87.5% of experienced crypto investors in one qualitative study showed FOMO and herd mentality as significant drivers of their investment decisions, even when they knew the risks, even experienced holders. The habit of constant price checking does not make you more informed. It makes you more reactive. And reactive in a volatile market almost always means selling low and buying high, the exact opposite of how wealth is built. The practical fix is straightforward. Set a schedule. Check your portfolio once a day or once a week if you are a long-term holder. Turn off the notifications. The price will be whatever it's going to be whether you check it 50 times or once. The only difference is how many emotional decisions you make in between. Habit 3. Diversification. Spreading your money across too many coins until your portfolio is just a tracking error of the whole market. Diversification is a real and important risk management concept. Diversification is what happens when you take it too far and end up holding 20, 30, 40 different coins with no coherent thesis connecting any of them. Here's what that actually produces. You buy a small amount of everything that looks interesting. Some go up, some go down, some go to zero. You spend more time tracking 20 positions than you would spend understanding 5 well. When one of your coins has a major development, a partnership announcement, a protocol upgrade, a regulatory ruling, you have no idea what it means because you never went deep enough to understand what you owned in the first place. And your overall returns end up approximating the average performance of the whole market, minus the fees and tax events generated by constantly rebalancing between all those positions. Academic research on portfolio construction is consistent. Beyond a certain number of holdings, additional diversification does not reduce risk meaningfully. It just reduces your ability to understand and monitor what you own. The sweet spot for most retail investors in crypto is between 3 and 7 positions that you have researched deeply, understand completely, and have a specific thesis for. Not 30 coins you heard about in different YouTube videos. 3 to 7. Owned with conviction, monitored intelligently, and held on a timeline that matches the actual use case of each asset. Habit 4. Ignoring on-chain data and only reading charts. Charts are useful. They show you historical price behavior. They show you patterns in volume and momentum, but they do not show you what is actually happening inside the network. And in crypto, unlike in traditional equities, the most important information about the health of an asset is on-chain and publicly visible to anyone willing to look. Daily active addresses tell you whether real people are actually using the network or whether the volume is manufactured. Total value locked tells you how much real capital is deployed in the ecosystem. Developer activity on GitHub tells you whether developers are actively working on the codebase or whether development has quietly stopped. Whale wallet movements tell you whether large holders are accumulating or distributing. None of this information is on the price chart, and none of it is hidden. Tools like Glassnode, Santiment, and Nansen publish on-chain metrics that institutional traders pay thousands of dollars a month to access, but the basic versions are free. The Federal Reserve of Philadelphia published research in 2024 documenting that large Ethereum holders demonstrated behavior consistent with informed investors, increasing their holdings before price increases, while small retail holders reduced their holdings before price increases. The large holders were reading the on-chain data, the small holders were reading the price chart, and they made opposite decisions at exactly the wrong times. The habit of constant price checking is not neutral. It's actively putting you at an information disadvantage against the participants with the most capital in this market. Habit 5. Trusting influencer calls without verifying. And I want to be careful here, because this is not a criticism of everyone who creates content about crypto. It's a specific, documented, research-backed warning about a pattern that has cost retail investors enormous amounts of money in every single cycle. The Elliptic State of Crypto Scams 2025 report identified pump and dump schemes as one of the most common fraud types targeting retail traders, and they explicitly noted that influencers are increasingly the delivery mechanism. A peer-reviewed study in the Journal of International Financial Markets found that over 60% of sudden hype waves on X in 2024 were traced to coordinated accounts pushing misleading information. 70% of pre-pump volume in documented manipulation events transacted within 1 hour of a social media announcement, meaning the insiders were already positioned before the post went live. And the Hawk token, launched in December 2024 by the viral Hawk Tua creator, surged to a $490 million market cap and then lost over 95% of its value within 20 minutes of launch. One wallet held 17.5% of the supply and converted it to $1.3 million within 90 minutes. The retail investors who bought because they trusted the creator's platform, many of them new to crypto, took the loss. This is not an isolated case. The SEC targeted over 40 influencer-driven coin promotions in 2025 alone. The structure is almost identical. Influencer builds audience, launches or promotes a token, insiders exit, retail holds the bag. The verification habit is simple and it takes 10 minutes. Before you buy anything recommended by anyone, check the on-chain token distribution, check the vesting schedule, check whether the influencer or their associates hold a significant percentage of supply. If the information is not publicly available and verifiable, that's your answer. Habit 6. Never taking any profits and riding your gains all the way back to zero. This is the habit that creates the most painful stories in crypto, and it's driven by an emotion that feels like conviction but is actually something much more dangerous. It's called loss aversion dressed up as belief. Here's how it plays out. You buy a coin, it goes up 300%. You feel like a genius. You tell yourself this is the coin that is going to change your life, so you don't sell. It goes up another 100%. Now you're genuinely up, but you still don't sell because you're convinced it's going higher. And then it corrects, not a little, a lot, because that's what crypto does. Bitcoin itself has historically drawn down 60 to 80% from all-time highs in every bear cycle. And the altcoins that drove those 300% gains, many of them never come back. They don't recover. They don't make new highs. They just slowly bleed until they're worth a fraction of what they were. And the person sitting on what was once life-changing money now has to choose between selling at a massive loss or holding something that may never recover on a timeline that matters. The discipline of taking partial profits at predetermined price targets is not weakness. It is not a lack of conviction. It is what separates the people who actually realize gains from the people who only ever have them on a screen for a few weeks. A simple rule used by many experienced crypto investors: sell enough at your first major target to cover your initial investment plus your tax liability. Then let the rest ride with house money. You cannot go back to zero if your original capital is already out and you still participate in any further upside. The habit of never taking profits is not a long-term strategy. It is a guarantee that at some point in some cycle, you will watch a fortune on a screen disappear before you ever converted it into anything real. So here is the full picture. 6 habits. All of them feel completely normal. All of them feel like smart behavior. Overtrading feels like being active. Checking price feels like staying informed. Over-diversifying feels like managing risk. Chart-only analysis feels like doing research. Following influencers feels like leveraging expertise. Never selling feels like having conviction. And every single one of them is costing you in fees, in taxes, in emotional decisions, in information disadvantage, in missed profits, in positions you should never have entered. The market is not the problem. The habits are the problem. And habits, unlike markets, are completely within your control. You can change a habit starting today. You cannot change what the market did last week. Start there. Fix the habits and let the market do the rest. If this called out something you recognize in yourself, smash that like button right now. The algorithm shows this kind of honest, useful content to more people when it performs, and that is the only way it reaches the beginners who need it most before the market teaches them these lessons the expensive way. Subscribe if you want content that tells you what you need to hear instead of what you want to hear. Real data, real research, real talk about how this market actually works. Now here is your comment question. Which one of these 6 habits has personally cost you the most money, and do you still catch yourself doing it? Drop it below. The most honest answers in these comments are more valuable to other holders than anything I could add to the video. And if you know someone who just got into crypto and is sitting on a gain right now wondering whether to sell any of it, send them this before they make habit number 6 the most expensive lesson of their investing life. Know your habits, fix the ones that are costing you, stay in the game.